Hello, welcome to AmericaFirst Wealth Management Investment Outlook for January 13th, 2025. My name is Dan Liu. I'm the Chief Investment Officer and Portfolio Manager at AmericaFirst Wealth Management. This is our standard disclaimer. This material is intended for information purposes only. We're not offering investment advice, recommending to offer or sell any securities. These are opinions as of January 13th and are subject to change without notice. So what we like to do is to give our outlook initially, and right now the S&P 500 appears to be breaking below the initial 58.61 support. We're slightly below that now, about 58.30 something. The second technical support level is 57.24. We are currently leaning towards the bearish point, and as we mentioned 2 weeks ago, S&P 500 valuation levels are too high. And there is a very high concentration of S&P 500 weighting into top 10 names. And these are at historically high levels, which have coincided with corrections. The other point we'd like to make is household equity allocations are at all-time highs, and that forces us to question whether or not households will continue to increase their allocations, especially after 2 very strong years in the stock market. The big news, obviously, last week and into the weekend and today is that the LA fire damage continues to grow. The fires are far from being extinguished. The estimates are now at 150 billion in damages, and people will recall that Hurricane Katrina had damages of 125 billion. That was, I believe, in 2005. Can inflation adjust that? Hurricane Katrina damages in today's dollars would be about 205 billion, I believe. So with the fires far from being put out, it's likely that the damages will grow. And LA is the second largest city in the country, and its population exceeds that of many states. So unfortunately, the damages are likely to grow. Hopefully the Santa Ana winds will not be as damaging. There are, however, forecasts that they will kick up again this week. So historically, natural catastrophes tend to be over very quickly and tend to trigger insurance payments and economic recovery. But being that this catastrophe is not over, we have to be wary that it can trigger effects that will linger and proceed to have further damage. We do expect there to be a number of bankruptcies triggered by this. Certainly smaller insurance companies with large California exposure are going to be impacted. Even the large major insurance companies and those who have used reinsurance are all going to be impacted as the risk is shared among all these groups. This is likely to trigger a selling of many insurance company assets, which are largely fixed income and bonds. This will create some pressure on interest rates, we believe, as there is a rush to raise cash to be distributed to insurance claims. So there should be a large effect in terms of asset sales. Hopefully at some point down the road as rebuilding and use of those payments will work its way back into the economy. That should be somewhat stimulative, but it's unlikely that the insurance payments will make everyone whole because there'll be a lot of claims that'll be contested, and it takes time for the money to be worked into the system. And insurance companies will tend to fight to minimize their payments. So it could be delayed somewhat. We'll likely see the government step in and hasten the process to make sure it goes smoothly. But as noted, some of these companies will be fighting for their financial survival and are likely to delay the process. Turning to key macro data points for this week. Tomorrow, Tuesday, we got PPI in the morning. Wednesday, very important core inflation data will be coming out. Thursday morning will be retail sales, and Friday we're seeing some building permits and housing starts data. Those appear to be the key macro data points we're looking at this week. Hopefully, in this case, we are hoping for a reduction in control of inflation, which would allow market pundits to hope for a reduction in rates by the Fed at their next meeting. Turning to S&P 500 company earnings this week, we see a lot of financials. We got Progressive, which is an insurance company, on Tuesday, starting off the week's earnings. We have a lot of the major banks and brokerage firms, investment banking firms reporting. BlackRock, Mellon, Citigroup, Goldman Sachs, JP Morgan, Wells Fargo on Wednesday. We're going to look for their commentary on the impact of the LA fires and what they see as potential impact. And one of the key things we're looking at is what they will say with regards to performance of mortgages of properties that are completely leveled and then gone by now. Will homeowners continue to be on the hook to pay those mortgages, or will they be some sort of pause or reprieve on those payments? If not, there is potential risk that banks may be on the hook to eat those losses if they retain them on their balance sheets, and certainly that could trigger some concern among collateralized mortgage obligations on those mortgages, which could have further impact if insurance companies, which hold those CMOs, are forced to sell it and seeing the value of that paper drop if those mortgages become non-performing. So that's something we're looking at analyzing closely. Moving on down the week, Thursday, in addition to Bank of America, M&T, Morgan Stanley, PNC, and U.S. Bancorp, United Healthcare will be one that we'll be looking at, especially after the CEO was assassinated last month, looking to see what United Health will be saying about their business and their operations going forward after that tragic event. Also on Thursday, we have J.B. Hunt, which is a bellwether trucking name. Be looking at their commentary in terms of trucking and transportation activity. Closing out Friday will be Citizens Financial, Fastenal, Huntington Bank, Regions Financial, SLB, which is the energy services space, the old Schlumberger, State Street, and Truist. So we're kicking off the earnings season with a spate of financial companies, and we'll be paying close attention to those. This is a chart I showed 2 weeks ago, which I think is still relevant. Current S&P 500 forward PE levels are high relative to its history, and subsequent 10-year returns with this level of forward PE has never been good in terms of a 10-year return going forward. So it does flash a warning sign for us. Point I made in the summary before, the high percentage of the top 10 names in the S&P 500, which are about 38% now. This has coincided in the past with market corrections, and this current, I'm not using this as a prediction, but it does coincide with the concentration of the top 10 names in the S&P 500 at a level which had only existed at a period in time before known as the Great Depression. So hopefully we don't have that type of a correction, but history does have a way of rhyming when these events occur, and I think a healthy correction is probably warranted. And we made notice that Warren Buffett, Berkshire Hathaway, is sitting on worth 350 billion in cash right now. So he's obviously seeing the same concerns about valuation and coincidence with historical anomalous highs. So I think it's important to be aware of that, and investors should have a we think should have a position where they are not all in, but have dry powder to take advantage of any corrections that bring valuations back to a average or below average valuation. So, especially after 2 strong years in the market, that is a prudent thing to do. This chart shows the percentage of U.S. household allocation to stocks, which at the end of Q3 2024 was at 43.4%. That's an all-time high. And we do have to question whether or not this percentage allocation will continue to increase, especially as the S&P 500 looks like it's hitting a speed bump here. And we have a lot of things to be concerned about, the LA fires. We do have things to be hopeful for as well. We have next Monday, we have the inauguration of Trump as the 47th president, and that will hopefully be a positive influence on the markets. But we do have to bear in mind that the new administration will be handed over a market that is relatively high in terms of valuation, and also saddled with a public debt which is 35 trillion plus and growing. So the balance sheet could be under some strain, but at the same time, money market levels are at record highs of, I think, about $7 trillion. So there is a lot of dry powder there. We're also looking for the Trump administration to execute on their promises to reduce government spending. We're going to watch what Elon Musk and Vivek are going to be doing with their DOGE, Department of Government Efficiency, in terms of finding some efficiencies and reducing government spending. So hopefully that'll have the effect of showing some fiscal discipline and hopefully leading to a reduction in inflation concerns and government borrowing costs, which, as we'll point out shortly, is manifest in rising interest rates. Turning to the weekly market stats ending last week, we can see I'm going to point to year to date. We're starting off with some negative numbers for the larger cap indices. NASDAQ is still up slightly on a year-to-date basis, but pretty much across the board, we're starting off year-to-date with a sell-off, and certainly after the strong 2024 and 2023 returns, which are shown here. S&P 500 being up 23.3 in 2024 and 24.23 in 2022. Those are very healthy and respectable returns. And we don't expect to have another year of such strong returns. That would be three in a row. If it happens, it'll have to come on the backs of companies predicting much higher sales and revenues. And we don't see that occurring when we go through this current earnings season. So unless there's something dramatic that occurs with the Trump administration, which could happen, he's talked about tax cuts and hopefully some other benefits for companies, reduction in regulations. But I think right off the bat, with the reporting of the fourth quarter numbers, we're likely to see more caution than optimism. So, but as the year progresses, I think there should be some upside opportunity. I think we can expect to see some M&A activity as companies take advantage, especially not among the largest 10 overvalued names, but among the lower valued names. And with deregulation, we think companies will be taking advantage of that in terms of M&A activity to improve their market position or to grow sales and also find areas to cut costs. Turning to the Magnificent Seven names, you can see year to date, we've got only three of those names up and four are down. So a little choppy off the start. We'll be watching this list carefully, as well as to see if there's any broadening out of breadth into other areas. And we've positioned the market indices now down below the Magnificent Seven, so we can do a quick comparison to see how these names are comparing versus the broader index. And we're seeing that Magnificent Seven names, I think on average, are underperforming the S&P and the Dow, but looking like they're keeping more in line with the higher growth, higher volatility NASDAQ index. Turning to sector performance, we are seeing energy and healthcare being the leaders, the only two sectors that are positive for the last week and also year to date. This is a shift in leadership. As we can see, tech is next to last on the bottom on a week-to-date basis, and while not at the absolute bottom, on the year-to-date, it's not too far from the bottom in terms of sector performance. Turning to the S&P 500 post-election on November 5th returns, looks like we're getting back to a euphoria that we saw post-election is now selling off, coming back close to the post-election day level. So we're seeing no advance there. And the S&P 500, the 1-year chart, we are below the 10-day moving average. RSI is dropping, getting towards the oversold area, but looks like unless we have some bounce here, it does look like it's trending downward to us. Turning to the technical chart that our resident technician, Jim Monahan, provided us, the 5861 support level is breached as of today's close. And the second support level is 5724. So would like to see a bounce this week. If we don't have it, it's likely that we're going to be heading towards that second level support. Turning to the 10-year Treasury yield, still rising. We're at 4.77% as of Friday, up 17 basis points from a week prior and up 19 basis points from year end. So this is certainly a problematic area, and we will watch. The markets obviously will heed notice of rising finance costs, which is particularly at a time when there's a large amount of treasury auctions and corporate debt and commercial real estate refinancing that needs to occur this year. So higher long-term rates will not be supportive of companies and the government reducing their interest costs. Turning to yield curve, the good news is we're now looking at a positively shaped yield curve, whereas last year, most of the year, we saw an inverted curve. There's still some room to go at the short end. We think the Fed will need to drive the short end down because obviously they have not been able to lower the longer term rates. So it's not the way we want the yield curve to be shifting with long rates higher and short rates lower. Would have been nicer to see, obviously, lower low rates and lower long-term rates. It is what it is. We're getting back to a possibly slope yield curve with the long and the short moving a little differently and at different rates. The economic calendar I kind of summarized, so I'll just flip through that kind of quickly. Tuesday again, PPI. Wednesday, inflation. Thursday, retail sales. Building permits on Friday. And notably, I don't think we saw any Fed governors speaking during the week, so the Fed is kind of quiet as they go through their notes and thoughts for their upcoming meeting. S&P 500 earnings are listed here with the consensus numbers a year ago. I'll just leave them up for a little bit, but I won't go any detail. And this is Friday's. And with that, if anyone would like to sign up and receive information on these weekly updates, please go to AmericaFirst.fund. And if anyone would like to learn more about our products or services or to schedule a one-on-one call with us, please contact us directly. My email and Jim Monahan's email are listed here. Thanks for tuning in. We'll be coming back to you next Monday or Tuesday. Monday is Martin Luther King Day and the inauguration. Markets will be closed. So we will either have an investment outlook on Monday or on Tuesday, depending on what data we're seeing and whether or not we feel there's something important to be put out on Monday. But certainly by Tuesday, we'll get this out. So thanks for tuning in, everyone, and be safe out there, especially if you're out there on the West Coast. And we hope that the fires are out soon. And for the rest of the country, stay warm. It's getting cold out there, and stay safe as weather and conditions make it a little more dangerous to venture out. So thank you, and good luck with investing, and we hope everyone was very successful last year and are beginning this year with a degree of cautious optimism. And just remember that a correction is healthy given the state of the economy, the strength of America, and also the optimism we're seeing with the new administration coming in. So thanks for tuning in. Take care. Have a good week.